The greatest business ideas that were developed to make our lives as convenient and entertaining as they are today required some sort of financial investment to, first of all, bring them to inception and then grow them to where they are. Let us take Facebook, for example, a social media project that was started by then Harvard student Mark Zuckerberg from his dorm room. When it launched in 2004, about 1,500 students signed up on the platform, and it later expanded to other campuses around the area. By the end of that year, the site had over 1 million users. Because the founder was looking to make this platform profitable and not just some passion project, he realized he needed funding to make that happen. He then sought help from venture capitalists when angel investor Peter Thiel invested $500,000, and that's when Facebook started its upward growth trajectory to now be valued at billions of dollars. This whole narration makes you think how many business ideas that could be another income stream or drastically change our lives for the better go unexplored because of a lack of funding. However, it is not because of the absence of trying that is. It has been shown that a lack of collateral discourages many aspirant entrepreneurs from taking that first step to seek capital from financial institutions to fund their business ideas. Additionally, one might also argue that because the only way that a lot of people know they could get funding is through a banking institution and nothing else is also a deterrent. But did you know that you could raise capital on the stock exchange to fund your business idea? To a layperson, this sounds outlandish, but it is quite possible. To talk us through how that is and how you can explore the option for future endeavors is Chief Executive Officer at the Botswana Stock Exchange, Thapelo Tseole.
There are a number of ways in which someone or a company can raise capital in the stock market. The first and most commonly known one is to issue shares to individual members of the public who are investing in your company. So what will ordinarily happen is that you come as a company and then you sell your shares to different people, and then these people actually buy your shares, and there's an exchange of shares for money, and that is how you raise capital in the market. And you can do this at different levels, either as a startup company, either as an already operating company in the economy, or either as a company that is big enough, which will ultimately get into the main board. The other alternative way of raising capital in the market is by not necessarily listing in the market, which is why I said issuing shares, is by way of issuing a bond. A bond is like a debt instrument. So as a company, you come to the market and then you say, I have a project, or as a company, there's a certain amount of money that I need from you, from the investors. And this is the quantum that I need. And then we'll look at your application, and then you will issue a bond to the market. And certain people in the economy, or different people in the economy, will subscribe to the bond by giving you money, and then you give them units of the bonds.
Our conversation today is with the understanding that the company that would be home to the business idea is not yet operational. But listing on the stock exchange has certain requirements, like providing financial reports, for example. But how does it work, facilitating the sort of exercise without those prerequisites?
If it's a new company, what we actually require is that you should be an established company, you should be operating, and not necessarily having financial history, which we can call past audited accounts. So you are a startup company in that regard. You have got directors in place. You just need to know how much capital you need. And therefore, under these characteristics, you can be able to come to the market to say, I've got a business idea, and this is my business idea, which I'm going to be selling basically to investors. And then your business idea needs to be attractive enough for people to like it. And when people like it, they will be able to buy in your business idea and therefore subscribe to your shares by giving you money and then getting shares in your company.
like any other investment that one would wish to undertake, there are always risks involved, right? So I'd wish for you to talk about at this point the kind of risks that both the person seeking investment from investors and the investors themselves need to understand about this undertaking.
The startups generally are more riskier investments. When a company is started up, it means that it doesn't have a past history, it doesn't have a past operation. And therefore, when you buy shares in such company, it's actually far much more risk than when you buy in a company that has been operating, that it's been there, that you can see. Here you are just taking a risk on the unknown. You are taking a risk into the future, which might pay off, or you can also lose everything that you have invested in the company. And also, as a business person, when you start this company, you can get money from people, come list in the stock market, and then your business idea might not survive the economic fundamentals, and you ultimately risk and collapse everything as a company.